MRTA versus MLTA, which is better in Malaysia? Why do you need mortgage insurance in the first place? It's actually to settle your outstanding loan with the bank in the event of death or total permanent disability, TPD. The insurance pay off your remaining debt to the bank. It also prevents repossession, that it protects your family from losing their home and the bank from auctioning off your greatest asset during a crisis. It's also some of the bank approval requirements. While not legally mandatory by Bank Negara Malaysia, most financial institutions require mortgage insurance as a condition for loan approval. What is MRTA, the budget option? It's actually a reducing term assurance. The sum assured decreases over time, mirroring your outstanding loan balance until it reaches zero. The beneficiary is the bank. The payout goes directly to the lender. Your family gets debt-free house, but no additional cash benefit. Lump sum payment. So it requires a one-time upfront premium, which can be financed into your home loan package. So sometimes you encounter 90% margin for your housing loan, plus another 5%, which is actually the MRTA. What is MLTA, the flexible option? It's actually known as level term assurance. The sum assured remain constant throughout the entire tenure, regardless of how much you have repaid your loan. So your beneficiary is your family. Payout goes to the nominated beneficiary that you have nominated. They settle the bank loan and keep any remaining cash balance. Cash value accumulation includes a saving component. If no claims are made, you can receive a guaranteed cashback at the end of the term. It's also a periodic payment. Premium are paid periodically, whether it's monthly, quarterly, or annually, throughout the life of the policy. The cost comparison. MRTA itself is a one lump sum, whereas MLTA is periodically. Upfront cash is low since it can be financed for MRTA, whereas MLTA will be moderate to high. The annual premium estimate is not applicable since it's financed in, whereas MLTA could actually range from 2,000, 4,000, or 10,000 depending on your covered amount. So the total cost in 30 years could be around 12,000 for MRTA, whereas MLTA could be 120,000 estimated. This is based on a 450,000 loan for a 28-year-old male. Actual premium may vary depending on the age, health, and loan tenure together with the covered amount. So protection-wise, declining versus constantly, MRTA is on a declining path. So if anything happen, let's say in the next 15 years, the insurance pays exactly what is owed to the bank, and your family gets the house, but zero extra cash for the living expenses. Do take note, for example, if interest rate were to increase over the years, your MRTA actually may be lower than the cover amount of the loan balance. This is because the extra interest is being incurred into your loan account. For MLTA, it's a constant shield, so the payout matches the original sum regardless of time. Your family pays the bank and keeps the extra remaining cash as a financial cushion. So say for example, if your loan is 500,000 initially, 15 years down the road, maybe the outstanding is 200,000, but MLTA will be capped at 500,000. So should anything happen, there will be an extra buffer of 300,000 ringgit, which is the 500,000 minus the 200,000 outstanding, and your family can use that as part of their living expenses. Another thing will be actually the interest rate protection. MLTA protects against interest rate hike that might cause your loan balance to exceed a declining MRTA coverage. Transferability and flexibility. MRTA is actually tied to the property. MRTA is non-transferable. So in the event that you sell your house or you refinance the loan, the policy is usually terminated and you must buy a new one at a higher age-based premium. So for example, if your loan, you took it at the age of 30 and 5 years down the road, you are 35, the insurance premium for, let's say you're covering for the same amount, you are probably paying much more higher. MLTA-wise is tied to the person, so it's highly flexible where it can be transferred to a new property or a different loan, making it the preferred choice for property investors. Let's say, for example, today you have 3 properties and you have offset 2, and you have decided to buy another few more properties. You don't have to purposely rebuy and pay a higher premium. You can just do a top-up, or if the coverage and the loan amount is similar, you actually need not to do anything. You just continue to pay the original MLTA. Surrender value-wise, unlike MRTA, MLTA policies can be surrendered at any time for their accumulated cash value, providing a financial exit strategy. So who should choose MRTA? Long-term homeowners, if you plan to stay in the same house for the next 20 years and don't need the flexibility to transfer the policy. Tight monthly budget, if you prefer a one-time payment that can be financed into your loan without any headache, that is one of the suggestions to take MRTA. And if you have existing life policies, you have adequate personal life insurance and only need the extra mortgage MRTA to clear off the debt, and you want a pure debt protection, you're not looking for any savings or investment element and only want to ensure the loan is settled. So who should choose MLTA? So breadwinners, you want your family to receive a cash payout beyond just a paid-off house to cover living expenses. Property investors, you plan to sell, upgrade, or refinance within 5 to 10 years and need a policy that can easily be transferred. Savings-oriented buyer, you prefer a policy that doubles as a saving plan with guaranteed cash back feature at the end of the term. Comprehensive protection, you want to add on riders such as critical illness or other medical benefit for the full coverage. So in summary, we go with MRTA first. The sum assured is on a reducing term or it matches the loan, whereas MLTA will be constant. Beneficiary is the bank, whereas MLTA is for the nominee or your family member. The premium is low since it's lump sum, financed to the loan, whereas for MLTA is high and is periodic. There will be no cash value if you choose to settle the loan at the end of the tenure of your loan for MRTA, whereas MLTA could be guaranteed or non-guaranteed, but there will be some kind of cash value. MRTA-wise, you can't transfer, whereas MLTA you can. Medical rider-wise, you sometimes cannot include it in MRTA, whereas MLTA is optional depending on your choice. So final verdict-wise, which is actually better? Choose MRTA for cost effectiveness, set and forget debt protection if you plan to stay in your home long term, or it's your one and only home. Choose MLTA for flexibility, family cash benefit, and investment-friendly feature if you are an investor or sole breadwinner. Shop around, you're not obligated to buy from your lending bank. Compare quotations from independent broker. And a pro tip is to review your existing life and medical insurance before deciding. You may only need the debt specifically covered by an MRTA. So I thank you. If you have any questions, you can feel free to comment, or you can actually check my description for my details. Thank you.